Good afternoon, folks. Thank you so much for joining us today for Intro to Finance. We are excited to host this session as a part of our Integral Intro series, where we cover foundational areas of nonprofit management. My name is Sandeep, and I am the Manager of Education here at IntegralOrg. I will be hosting today's session, so you can reach me in the chat at any time. We'll be using the chat feature of Zoom today, so please don't hesitate to drop any comments or questions that come up along the way. We will circle back to them at the end during our Q&A period. We will start today's session with a land acknowledgement. We would like to acknowledge that IntegralOrg is based out of Mohkinstsis, which is the Blackfoot name for elbow. This refers to the confluence of Elbow and Bow rivers that run through Treaty 7 territory. Mohkinstsis is the traditional territory of the Blackfoot Confederacy, which includes the Siksika, Piikani, Kainai, as well as the Stoney Nakoda First Nations, consisting of the Chiniki, Bearspaw, and Goodstoney First Nations, the Tsuut'ina First Nation, and the Métis Nation of Alberta District 5 and 6. We have a long way to go in addressing the tension between the legal and governance structures that we work within in the nonprofit sector and efforts towards truth and reconciliation. We at IntegralOrg accept our responsibility to work towards reconciling this tension. We commit to remaining in a position of humility as we consider our history and current reality, knowing that the answers are not clear and easy ones, yet they require all of us to engage. We all have a connection and responsibility to the lands that host our lives, communities, and work. With that, I would like to welcome our facilitator for today's session, Stella Penner. Stella has decades of experience providing financial reporting and governance support to charities and nonprofits. Previously, Stella has held various roles in professional development and as a full-time instructor in financial and management accounting, audit, finance, as well as organizational design and analysis at universities and colleges in Edmonton and Calgary. She also has executive experience as a prior CEO of CGA Alberta. Welcome, Stella. I will pass it over to you.
Thanks, Sandeep. I just want to reiterate a few housekeeping things before we move on to the topic. So as Sandeep mentioned, it's a very tight time with just 1 hour. So if you have questions about the material that you'd like me to expand on, if you put them in your chat, and we'll address them at the end. This means that it's possible we may go over the hour depending on the number of questions, but that way the people with questions can hang around and we'll address them. And if you have to go, we understand. The other thing is if you have questions about something I'm saying that just seems blatantly contradictory to something I said on a prior slide, then feel free to interrupt by perhaps unmuting yourself and interrupting or putting in a more urgent kind of chat message. Sandeep will be watching that, but if I say something, if I misspeak or something, I would like to correct it on the spot. With that in place, let's move on. So the basic outline of what we're going to be covering today is, your nonprofits or charities, or probably both. Maybe I should just pause a moment to discuss the distinction. When I use the term charities, I'm talking about a registered charity. So someone in Canada that has registered charity status, an organization, and that a registered charity obviously is a nonprofit organization. But there are a lot of nonprofit organizations in Canada that are not registered charities. And so registered charities are like a subset of nonprofits. But just to keep things clear in this session and anytime I teach, when I say nonprofit, I am generally talking about a non-for-profit organization that is not a registered charity. Just so I don't have to constantly be saying a not-for-profit that is not a registered charity. I'll just say nonprofit. I'm talking about not registered charities. If I say registered charities, I'm talking about registered charities. Now, in today's session, there's not a lot of distinction between what's applicable to the two different sets of nonprofits, but in case you hear me use those terms, that's what is going on. But anyway, as charities and nonprofits, all of you will have a board of directors, whether you call that a board of governors, a board of trustees, or something like that. We'll just call it the board or the directors. You will probably all have a treasurer if your legislation, if you're incorporated under the Societies Act in Alberta, you would be required in your bylaws to specify a treasurer position. Most other nonprofits have one, even if it's not legislated or mandated. And then you'll have someone that actually does the bookkeeping or accounting. So it may be a department of several people. It may be a part-time freelance bookkeeper. It may be some combination, but you have somebody that actually records your financial transactions that's probably not the treasurer. And so we'll look briefly within the concept of finances, what the roles of those three parties are. And touch just briefly on what the role of your executive director is in that context as well. Then again, because boards have such an important role to play in a nonprofit, we'll talk a little bit about what is the kind of information that the board needs, financial information the board needs to fulfill its various roles. And then we'll talk about what we mean by internal control and the purpose of it in the broader sense. And then the main part of our hour is going to be talking about financial controls. So again, financial controls are a subset of internal controls generally, and obviously our focus today is finances. And then a last sort of drilling down even a little bit further in financial controls is what is the connection between having a budget and having good financial controls. So that's sort of the roadmap to where we're going. Let's start off by looking at the roles of the key players here in the finances and financial reporting of the organization. So the board of directors, I'm sure you're all aware, has an oversight function. So as a nonprofit, you have been granted certain, or a charity, you've been granted certain rights by society, by the government, by our legislation, and you are, for the most part, using resources that do not belong to the directors. They have been granted to you by grantors, by donors, by members, but you're using somebody else's money. And so it's the board's responsibility to report to and serve in a fiduciary capacity in overseeing that the resources provided by those outsiders is used reasonably. And that's what we refer to as stewardship, that money is not being wasted on Learjets while kids are going, starving kind of thing. And so the board has that broad responsibility to society at large, to your members, to your donors, to look after that financial resources are being well used, that laws are being complied with, that risk is minimized to the extent possible, and that the organization is being run in a way that would be acceptable to all of those donors. So that's kind of the board. They're the big kahuna up at the top who's looking after things on behalf of society, on behalf of your members. And if you think of them as trustees, if you have an estate, if you've ever been involved with, helping with settling someone's estate or have someone in your family passed away, then you know that there is a trustee, an executor, who is dealing with the assets of that estate as a trustee, and the board basically are trustees. Within the board, or appointed by the board, usually is a treasurer. And again, I'm going to assume that in your bylaws and or in the legislation under which you're incorporated, that the treasurer role is a board appointment. That is the most common. there are some situations, depending on what legislation you're incorporated under and or what your articles of association or bylaws say. In some situations, a treasurer may be a staff position, but that's very rare. And it's usually in much larger kind of organizations where the treasurer role is held by a senior staff person. But let's assume for today that the treasurer is an appointee of the board. They are generally a member of the board, although it's not necessarily required. Most bylaws do require that the treasurer is selected from among the board members. So when you're doing your board recruiting and board development program, you may need to think about making sure that you have someone that would be capable and have enough business acumen and financial literacy to take the treasurer role. So what the treasurer does, and I find this particular role very hard to describe because every single one of these, I'm going to say, well, it depends. It depends on what your history has been. It depends on what your bylaws say. It depends on what your governance policies say. So if your board does not have a job description for the treasurer, I would highly recommend that boards always have job descriptions or role descriptions for each of their major officers, whether that's the board chair, a vice chair, a committee chair, or the treasurer. They need to know, what does the board expect? You appointed me, what do you want from me? But the norm, so what I've got on this slide is the most common set of responsibilities of the treasurer. So generally they would be advising the board, the finance committee and management on financial matters, helping with interpreting the financial statements, helping with, reassuring the board. Yes, I've looked in more detail. We don't have to spend a lot of time picking this apart because I've already done that. Yes, I have spoken to the executive director and I'm clear on what this information means. And so there'd be some expectation that the treasurer would have enough financial literacy to be able to take financial statements and convey them to the board, that information to the board in a way that non-financial board members can understand it. Another role that is often, or I might even say usually played by the treasurer, is to provide a liaison between the board and the auditor. So for those of you that are involved with organizations that have external auditors looking at your financial statements, again, I just want to explain a little bit about the role of the auditor and why the treasurer has a role here. So our audit standards require that the auditor communicate and have a connection with those charged with governance, oversight over financial reporting. Well, that's the board. The board has that governance oversight responsibility. And so the auditor's professional responsibility includes communication with the board. And if your auditor is not communicating with the board, either in writing or through meetings or via the treasurer or maybe through an audit or finance committee, but there needs to be some communication between the auditor and someone representing the board. And so that often, particularly in smaller organizations, is the treasurer, is that liaison, unless you have a separate audit committee. And then the treasurer also has a role to play in monitoring, looking at financial reports on a timely basis, assessing if corrective action needs to be taken, if more detail is required to understand the financial statements, where will they get that information? So that's sort of the treasurer's role in monitoring. And then the treasurer would also be anticipating what kind of questions will the board have as part of their monitoring responsibilities so that they can anticipate and have the information available. The other person that you don't see on this slide except by reference is your executive director. And again, that might be a general manager, that might be a CEO, there might be different titles, but it's a senior staff officer. And in, again, most board run organizations, the board has only one employee, which is the executive director. And so the bookkeeper or the accountant is a subordinate and reports to the executive director. From a practical point of view, many of the little questions that a treasurer might have are more practically addressed directly to the bookkeeper or the accountant. You don't always necessarily need to filter that through the executive director, depending on what your working relationships are like. But technically, the board or the executive director reports to the board, and the treasurer helps the board understand the financial part of what the executive director is reporting to the board. So the executive director will report other than financial information. They will, how are their programs coming along? How are their plans coming along? That kind of thing. You don't need a treasurer to help interpret it. But when the executive director provides financial information to the board, you sometimes want a little bit of expertise in looking at that. But technically, the financial statements come from the bookkeeper, is preparing them on behalf of the executive director, who is responsible for reporting to the board with the assistance of the treasurer. That's a long sentence to try and put everybody's role into one sentence. So the bookkeeper or the accountant provides that financial information to the executive director, who then officially conveys it to the board. Now, the bookkeeper or the accountant also liaises between the management team and the auditor. So the auditor will have day-to-day questions as they're doing their audit. Oh, I need a copy of this document, or can you explain this payable, or what is this bank transaction all about? Those kind of questions usually go directly to the accounting team. Very rarely is the executive director or the treasurer involved in those kind of those practical discussions. Can you get me a copy of that invoice or whatever? That would be the type of liaison between the bookkeeper and the auditor. So that's who the main players are. For the rest of this session, I'm going to assume that the three groups are fulfilling what I have described here as their most common roles. But again, be aware that in your organization, the boundaries of these different roles may be slightly different. So a very tiny organization, the treasurer may actually be the bookkeeper. It happens. In a very large organization, the accounting team may have 4 or 5 people on it, and it's the controller or the CFO that is dealing with some of these things, in which case the role of the treasurer becomes somewhat of a formality. But we'll assume that this is how things are laid out. So a big piece of finances and financial reporting in any organization is collecting information, financial information, and providing it to people that need to make decisions. Because so many decisions in an organization are affected by financial factors. And so let's take a look at some of the kinds of financial information that your board needs, because what I have found, both as an executive, as an auditor, and as a volunteer at the board level in different organizations, is sometimes the accounting staff or the bookkeeper gets frustrated by all the questions because they don't understand why this information is needed or how it's used in decision making. Other times I have seen board minutes of a client that go on for many years without a single reference to financial information. And I would suggest that that kind of a board is not fulfilling its oversight roles. They need some financial information to be able to lead the organization effectively. So let's look at 3 categories of information that your board needs around finances. So the first group I call questions around where are we now? So, and how does the organization know what today's financial status or situation is? So a really important part of that information comes from this statement of operations. It may be called the income statement. It may be called the statement of revenues and expenses. There are different names, but it's basically the statement that says, here is how much revenue we've earned in the period, and this is what our expenses were in the period. Now, I want to be really careful to point out that I said this is the amount of revenue in the period, not this is the amount of what we received in the period. So we sometimes get our revenue in a period other than when we earned it. So we may get a grant in December that's supposed to be used in January. Or we may, maybe part of what your organization does is provide, facilities for people to have events at. And so someone has an event in December, but they don't pay you until January. So the money comes in January, but the revenue is earned in December. So when I say the statement of operations, I'm talking about revenue earned, not necessarily dollars in and out. And then the same thing is on the other side when we're talking about expenses. We're talking about expenses, not expenditures. So sometimes expenses get paid in a different period than when they were incurred. So you may have your rent for January, you might pay in December. Well, that's an expense of January, but it was an expenditure you made in December. So let's just be aware, when I'm talking about the statement of operations, I'm talking about when the revenue and expenses were incurred, not when the cash came in and out the door. Another important piece of information that a board needs about figuring out what's our situation right now is comparing that income statement to the original budget or to the approved budget. And I would recommend, and we'll talk about it, I think I've got another slide on it later, is that budget to actual comparison always be then forecast or projected to year end. So it's all fine and good to know that at the end, the other thing I'm going to say, I'm always going to assume you guys have a December year end. If you don't, just pretend I'm saying some other month that fits within your year end. So assuming you have a December year end, it's all great that at the end of February, bang, we're right on budget for the first 2 months of the year. Yeah, but I want to know where are we going to be at the end of the year. So some organizations, there are a lot of charities, especially that are dependent on multiple small donations, get a surge of donations in December. And so at the end of every year, or I had a client that was a theater, and of course, and they were selling their ticket subscriptions, like their season subscriptions. They were getting all that money in June. Their June year end was, their June 30th was their year end. So wow, they always had a lot of money on hand at year end. Yeah, but it was going to pay for the next season's expenses. And by the end of the season, they would always be short of cash. Well, what happened? Well, because we weren't projecting to the next year end, we were only looking at a point of time. So that income statement compared to budget projected to where things will be at year end in order to get a really good picture of where we are now. The statement of financial position is another statement that many boards never look at, or if they do, they only look at it once a year. I strongly recommend that whether you're getting your financial reports monthly or quarterly, whichever it is, that a balance sheet always be included, and that over time, the board, with the help of the treasurer, will learn to read that balance sheet and help that. And I mean, the name of that statement is exactly what we're looking for. What is our financial position right now? Now, so we have a bunch of cash in the bank, but it's spoken for. It's cash that was received to run a specific program that is going to happen next year or next month or next quarter. That's where restricted cash or deferred contributions come into play. And that's why it's so important to look at the balance sheet. Yeah, we've got $1 million in the bank, but 900,000 of this is restricted for a specific program. We can't use it for general operations. We have to do this pilot project with 900,000 of that million. And so it may look like we're doing really good from the bank account, but it's important to understand that there's an obligation tied to a big piece of those assets, and that's where understanding restricted cash are often referred to as deferred contributions. And and how is that money already committed to something else can help really see what our financial position is. So that's information, statements, documents that will be provided to the board to help them understand where are we now. So another piece of information the board wants to know is where are we going? And so the financial information that helps with this kind of insight is, first of all, you'll have a strategic plan of some sort. So the board will have maybe every 3 years, every 5 years, we'll meet with senior management, maybe some other key stakeholders, and plan ahead. What are our priorities within our mission statement, within our goals? Some organizations call them ends statements. Some call them mission statements. Some call them just strategic plans. But anyway, what are the big picture things that we want to accomplish over the next 3 to 5 years? And among those different objectives, which have priority over others? So that's really important. Are our resources going to the priority plans? And how do we assess that if we haven't been part of the planning? Another thing, if you have a lot of investment in capital assets, I would also recommend that the board have access to what call a capital asset life cycle plan. If you've lived in condos or been associated with condominiums, you're well aware of the reserve planning that needs to be done, the engineering study that says, in 3 years, you're going to have to replace the roof. In 7 years, you're going to have to replace the parking lot, and so on and so forth. And this is how much money you need to set aside to make sure that roof can be replaced. This is how, when you're going to have to replace the boiler and set aside money for that. So if you own a building, I would recommend that you consider formalizing some sort of a capital asset life cycle plan so that you can plan ahead and not be caught off guard by suddenly the roof caves in or something. Now, that doesn't mean, now in a condominium, the organization would be required to set that. It's a legal requirement that you collect that money and have that money in the bank by the time that that roof falls in. In other nonprofits, it may be sufficient to just be aware that this is coming and have a plan, particularly organizations that are very dependent on a lot of individual donations or member fees and so on. They may, what I have found particularly as being a treasurer of a faith-based organization, that it's easier to, not easier, it's not super hard to do a capital campaign. So the roof is falling in, let's everybody chip in. Sometimes it's easier to do your fundraising that way than to be for 5 years setting aside money for that roof repair, because people are going, well, I'm giving all this money and it's just sitting in the bank. So depending on the nature of your organization and its relationship to funders, that capital life cycle plan may involve setting aside reserves or simply planning ahead for how are we going to fund it when that day comes. The other thing I think a board in most cases needs to know is sort of not only looking ahead for this current year that we're in, but also looking ahead for the next couple of years at a very high, big picture level. And so that might take a much more abbreviated form than the detailed annual reports that you're getting. But if this program is going to go ahead indefinitely, are we expecting to see growth in participants? Are we expecting to see a decline in participants? And what is that going to do to our revenue and expenses? If you're involved in an organization, that is reliant on unionized labor, you may need to be thinking 2 to 3 years ahead based on what your salary commitments are. And then finally, where are we going? Looking more in the short term, current year budget based on our actual action plan. Do we need to make changes based on what's been experienced so far? So that's financial information on where are we going. And then the last bundle of information are the information that the board needs for monitoring. And so that's information with respect to comparing actual to budget. We approved you to spend, $100,000 on salaries, and you've already spent 120. We need to figure out how to fix this. Or maybe there's a good reason for it, and there's already been alternative planning. Maybe that extra 20,000 in salaries is being covered by an internship grant or something. And so comparing actual to budget, understanding why there's variances, understanding what management's plan is to respond to those variances. And if management doesn't have a plan, does the board need to sort of impose a plan? Usually this actual to budget comparison is done on an exception basis. So as long as the forecast continues to be that this line item or this segment of the budget is going to come within 5% or 10%, it depends what your discretion is, of the original budget, then no explanations are needed. But if you're going to be off more than X%, then management needs to explain to the board what happened and what they're going to do about it. And then finally, the board needs to understand whether the plans and policies are being carried out, because that's a big, important part of internal controls, is implementing and enforcing board policies. And so looking at financial information, I've told this story before. I don't think that anybody that was part of it is part of today's group, but I had an employee who was really delighted after his first quarterly evaluation was, or his first, like it was Q2, so halfway through the year. He was really pumped because he had come in well under budget as far as his expenditures were concerned, and he was just expecting a real pat on the back. And as we discussed it, it turned out that his original budget or plan had been to organize a certain number of events in the period. And that was the budget. We're going to have like 10 events at universities and 10 events at high schools or whatever it was. And so when we went over his actual results, he had not done any high school events, and he had only done half as many university events as had been part of the plan. So if that information had gone to the board, it would have been very clear that their plans were not being carried out. And that came to light as part of reviewing the financial information. And so the financial information plays a role because it describes the activities that are going on. You have to look beneath the numbers at what are the activities that drove these numbers. So the first thing I want to talk about here briefly before we get into specific financial controls is what are internal controls, and that's that first bullet. When we as baby auditors start taking courses, and one of the things, one of the first definitions we learn is internal controls are those procedures that management puts in place to ensure that its policies are carried out. And so I'm going to give you a non-financial example of an internal control. Have you ever been to a restaurant bathroom where there's a sign-in sheet on the back of the door or somewhere where the people that are cleaning the bathroom have to mark it off every hour or every day or whatever? Yes, I checked. Yes, I checked. Yes, I checked. That's an internal control. Management has a policy that the bathrooms will be checked for cleanliness once an hour. That sign-in sheet on the back of the door is an internal control. Now, it's not a financial control, but that's the kind of purpose. Management will say, we want to keep a minimum of $50,000 in the bank. Well, how do we make sure that happens? Well, we review the balance sheet periodically. We have bank reconciliations done. There's a management policies, and the controls make sure that that's happening. Another purpose of financial controls is asset protection. So those are obvious things like who can sign checks, making sure that, keys are, confidential information and assets are locked up. Passwords are required to access bank accounts, just basic stuff like that, asset protection. If you have a lot of physical assets, locks on doors and limitations of who can access certain areas of your premises. Another thing that I think, in the 20, 30, 40 years ago, when I first started getting involved in boards and nonprofits, risk mitigation wasn't a big thing. I think organizations are recognizing more and more that the board has, if you have a fiduciary duty, you can never eliminate all risk. So you have a responsibility as part of your stewardship and trusteeship to keep risk to a manageable level or an acceptable level. And that will be different for different kinds of assets, for different kinds of situations. So if you're an organization that works with small children, much of your risk mitigation attention will be focused on protecting children from harm. And so the board has a responsibility to make sure that management is doing the steps that they need to do to protect the children in their care. And that's having a plan to protect. You can't get insurance if you don't have that kind of thing in place. Sorry, it shouldn't be up to the insurance company to make it happen. It should be up to the board to make sure that it's happening. Not by doing it, but by asking the questions and asking management for evidence that they have risk mitigation strategies in place. Other processes or controls are directed at finding the most efficient way to do things, and then finding a certain set around, especially around reporting, or for monitoring purposes. So let's look at some examples of these different kinds. The examples we're going to look at fall into two broad categories. So there's general controls that apply to everybody and everything in the organization. And then there's specific controls that relate to a particular action or transaction. And so whether the controls are general or specific, they may be preventive. So for example, requiring passwords and keys, those are preventive controls because they prevent somebody from doing something. Whereas reports that show variances are detective controls because they show after the fact that something was breached. And then there's a specific type of controls that we call separation of duties. And those are controls that have it built in that one person checks another person's work. So somebody wouldn't both be having, custody of the petty cash and be accounting for it and be writing up all the invoices that go into it. No, you have somebody else handing in a receipt and they will be initiating that receipt. So at the end of the day, there'll be a bunch of receipts that other people have seen that help balance petty cash. We wouldn't, and that's a very tiny example, but that's an example of separation of duties. So let's look at some entity-wide controls that are recommended. The first one is knowing your people. So that would include vetting both volunteers and new employees. So, normally you would ask for references in both cases, whether you're bringing in a new volunteer on board or hiring a new person, is get their qualifications for their particular role and check references. The other thing I would strongly recommend is that you document that you check those references. Another really important control is the culture in the organization, and that is set by the board and senior management. So if the senior management or the board is always saying, well, you can make an exception that, that's our board chair, we're not going to enforce this requirement, we're not going to make him hand in receipts. That is not setting a good tone at the top. If you expect your employees to follow policies, the best way to demonstrate to the employees how important the policies are is that management and the board also comply with those policies. And that sets that tone that we take this seriously. Another type of category of controls in here is access to information, protecting private and confidential information from people that should not have access to it, and not having your passwords on a little yellow sticky on the side of your monitor, and not sharing user names and passwords, you know, and just being careful that at the end of the day, one of the worst things that happened to me as an auditor, as the owner of an audit firm, is we had an employee go out to the client. The client was very, very conscious of privacy around employment information. So they had asked our staff person to work in a locked office when she was working on payroll, which is maybe a little more extreme than required, but not unreasonable. And so, and they also said, if you're leaving the office for lunch or for a bathroom break, please make sure that you lock the door behind you. And you don't even know where this story is going. No, she didn't just leave the office door open when she left. She took the payroll records home with her to finish the audit at home in the evening. There was some serious breakdown in the protection of access to information, and alas, it was the auditor that caused it. I've never been so embarrassed by a staff person in my life. No, she didn't work for us much longer after that. And then clear policies, including value statements. So if your board does not have a code of ethics and a statement of values, that's something that I would suggest you look at. And then sometimes organizations have a slightly different code of ethics or value statement for staff than what they do for board, and that's fine. There may be valid reasons, but they should both exist. Now we're getting a bit into the nitty-gritty with some of the specific controls that you'd want in place. Bank reconciliations that are done on a regular basis, on a timely basis, not all at year end. You want them done monthly, or the organization I'm currently working at, we actually do bank recs weekly. It's much quicker and more efficient, but monthly is a minimum. You want to know who can make purchases and who can make payment approvals. You want processes in place for how deposits and revenue is handled, who has access to that information. You want hiring and payroll policies, defined financial reports that are prepared on a regular basis, and then controls over making sure that regulations are complied to. So before we look at these specifically, I just want to be aware that I might be using different terminology. Cash and checks, you know what it is. Probably you don't get many of those anymore. EFTs are when two businesses transfer money between each other. So if you get a government grant, it will usually come by an EFT. Pre-authorized debits and credits. So with an EFT, the payor pushes the money to you. With a pre-authorized debit, you pull it from the donor's account. So that's the difference between those pre-authorized payments. One you pull, the other one the sender pushes. E-transfers or Interac or email payments, those terms are used interchangeably. It's not a payment method that I would encourage. It's very labor intensive to record it. And it's very, very subject to petty fraud. So you'll want to have very clear controls over email payments if you receive them. Wire transfers are not used much anymore unless you're sending money in or receiving it internationally, and then credit card payments speak for themselves. So you'll have different controls over each of these. So the bank rec is really important. I think that the bank rec is the key financial control in any organization, because at the end of the day, every expense, every piece of revenue at some point has to go through the bank. And so by looking at the bank reconciliation closely on a regular basis, it means that somebody at a higher level is looking at every transaction, maybe not at the moment when it happened, but after the fact. And so this is really important. It ensures integrity and honesty, and it enhances accuracy. And again, I strongly, strongly recommend that someone outside of the person preparing it reviews the bank rec and documents that they've reviewed it by initialing or sending back an email. I've reviewed the July 31st, bank rec for the checking account. I've seen that, nothing that I have no questions or something, but document the review so that everybody knows it's been done. Another set of controls or specific controls around purchase and payment approvals. Again, it's important to be clear on who can approve different things and at what stage those have to be done. Generally, I would recommend that the person who's in charge of a budget area should have permission to purchase things within that area, or it becomes a bit like, what was the point in having them be involved in preparing the budget? If they're going to be held accountable for it, the way we recommend with regular monthly reporting, then let them approve their purchases. If they go over or spend too much money, they will be caught through the regular financial reporting, and corrective action can be taken then. I also recommend that the budget person who's in charge of the budget area should code and approve those expenditures, because they know which budget line they were buying this thing for. And so the coding should theoretically be more accurate, rather than just sending an uncoded invoice to finance and letting them guess where you had budgeted for that item. This is a little side note here, that payment approval is separate from purchase approval. So somebody in the program area who's running the program says, well, we need to buy, snacks for lunches or something. They're the lunch program. And so they place an order with Cisco or whoever for snacks. Fine, they approve the purchase, but they can't necessarily approve paying it because they don't know if the money is in the bank. So the approval for the check run, yes, we have enough money to pay these 40 invoices, should come from somebody other than the person that approved the actual purchase. One's a cash flow situation, the other one's a budgeting situation. And then you'll want controls and procedures around deposits and revenue. If you do get cash and checks, how do you protect them while they're in your office? And how often do you take them to the bank? Is it like weekly, daily, when the amount exceeds a certain amount, whatever, but you want a clear policy on that so everyone understands. If you are accepting e-transfers, it's really, really important. I cannot stress this enough. I'm going to say you must do this. You must set up your e-transfers that they're automatically deposited. When somebody sends you an e-transfer, you get an email saying, Stella has sent you so many dollars. Click here to deposit it to your bank. You should be within your organization setting that up so nobody has to click on that to deposit. It goes directly to your bank. I can't stress this enough. And then the other thing is, whatever email those payments are going to, more than one person must have access to that email address. So do not use stella.penner@ as the email to which payments are sent. Have a separate email address that is giving or payments or something at X. And then have at least two people that can access that email so two different people are seeing that payment coming in, and so that somebody can't. I mean, I find it hard to say that you're not going to believe I've seen this, but I've seen this where somebody had admin rights on the bank account. They would periodically go and turn off that automatic deposit, and the emails were all coming to her personal email at the organization. Like not her personal, but her email, like, you know, Stella at whatever. And so she'd periodically turn that off. And when a small donation would come in, $20, $30, she would put it in her own personal account. And then she would go back and turn on the automatic deposit again. And because they only gave donation receipts if the donation was more than $50, it didn't get caught for a long, long time. And so that's the kind of, that's why you need separation of duties for this kind of thing. Hiring and payroll, I've alluded to this already. When hiring, check references, make sure that you have a clear documentation of changes, new hires, what the terms of the employment are, need to be all written down and approved, whether in an offer letter or something else. And then when somebody gets a raise or gets, you know, more vacation added or something like that, that should also be in writing via a memo that the person that's doing payroll or somebody in finance has it in writing, not just, oh, by the way, we gave Stella a raise to $25 an hour. Can you start that next month? Yeah, sure. You have no idea how often that happens. Like, but payroll changes should be documented in writing. And the other thing, if you're a small organization or a large one, I would recommend considering and using an external payroll service, ADP, Ceridian, Payworks. There's a whole bunch of different organizations out there that can handle your payroll for you. And again, that provides like a segregation of duties where someone else is, you know, an external party is doing the actual math for you. So that's a type of internal control, although it is external. Sorry, bad joke. And then financial reporting, you'll want to have policies around departmental managers. How often do they get their reports for the purpose of explaining variances, for the purposes of them knowing how their departments or programs are doing financially. That needs to be not on an ad hoc basis, but on a regular basis, probably monthly, and as timely as possible so that they, if they're in trouble, that it's not too late to take corrective action. Then there will be probably more aggregated reports going to senior management and even more aggregated to the board. And again, those are often run through the treasurer. Then there's also a number of financial reports that have to go to outsiders. So if you have members, they would get the financial statements annually. Funders usually annual. Donors, you may make your financial statements available to them in different reports. And that's where auditors come in. For the most part, external financial reporting is subject to external audit. Again, that depends on what your bylaws, your legislation, and your policies are. So if you are incorporated in Alberta under the Societies Act, the corporate registries will accept a review engagement as opposed to an external audit, or they will accept an internal audit, which is a whole different thing that's beyond the scope of today's courses. If you are incorporated federally, you'll have to have an external audit. If you're incorporated under the Companies Act in Alberta as a non-profit company in Alberta, then you would require an audit when your revenue goes above $1 million. So there's different requirements for external audits. But the external reporting is usually more aggregate and less detailed than internal, and it's prepared in accordance with accepted accounting principles. Internal, you want to set up your reports in a way that makes sense. External, you have to follow the CPA handbook. Then the last set of reports or controls that I want to talk about is regulatory compliance. And this is just making sure that the board knows that you have a plan in place, who is going to be responsible for preparing program reports. If a grantor or funder requires a program report, who's preparing those? Who's sending them out? Is it the fundraising department, or is it the finance department, or is it the program department? have that very clear. Who's responsible for tax filings and have they been done? What are the deadlines? Have some sort of a chart. You know, this is what needs to be filed. This is who it needs to be filed with. This is the deadline, and this is who is responsible. So I would suggest some sort of a catalog or table of these kind of responsibilities would form the basis of the policy. And then the last thing I want to talk about, again, just a subset of internal controls and how is budgeting considered an internal control. The first thing that I always say when I'm teaching the budgeting course is budgeting is planning. So as part of preparing the budget, you have to be aware of what your priorities are, what activities are we going to do to achieve those priorities, where is the revenue for these activities coming from, and how much will it cost to do the activities. So if you think of budgeting that way, you are thinking through and planning in quite a bit of detail that may or may not have dollars attached to it, but it's giving you a chance to do some planning. And in many organizations, when the budget is approved, that gives management the approval to spend the money. Other organizations have a policy that says once the budget is approved, you can spend anything in there as long as the item isn't more than, you know, $100,000 or $10,000. So there may be some caveats on the approval to spend, but in general, budget approval means approval to spend the money. Budget is also, like I said, a statement of priorities. If we said we were going to focus on children's programming this next year, and yet our entire budget seems to be devoted to adult programming, something is wrong with this picture. And then the budgeting also provides a basis for monitoring activities. So the use of budgets, I think, is a really important framework or even infrastructure for building up effective financial controls, because it forces you to think about who's approving what, who is reporting to whom, who is responsible for explaining problems, who is responsible for solving problems, what are our priorities, and how are we going to look back over things and see that we've done what was planned. So I think budgeting and bank recs are probably the two key controls that I would recommend to nonprofits and charities. So I'm going to just do a recap, and then we will take a look at the questions. But just for each of you, some of you in the session are employees, some of you are probably board members, some of you may be finance committee members. You have different roles. So when we went through that initial slide on what your roles are, did you slot yourself in and figure out? And then some of you are employees in one nonprofit and on the board of another one, and then on a volunteer committee for a third one. So you may have all the roles. Then the other question is, do you know what information your board is getting as far as financial information? And are they getting information to tell them where they are now, where you're going, and meet their fiduciary and monitoring obligations? Are they getting the information they need? Do you have a few basic financial policies and controls in place? Again, look at sort of some of the categories, and it's a bit like, you know, if you decide you want to get fit, you can't change everything at once. So, okay, I'm going to start eating more fruits and vegetables. That's all I'm going to do. And then once I've got a habit of doing that, then I'm going to start, you know, walking more often. So when you put in financial policies and controls, you're not going to put all of them in at once. You're going to look into the different areas and figure what is the key one. So in the area of the bank, getting those bank recs done regularly. In the area of HR, getting everybody's employment terms documented and approved. So start that way. General entity-wide controls, you probably want to start by getting your value statements and your codes of ethics in place, and then start enforcing things like password protections and accesses and so on. So you can start at the highest level, and once you have the big stuff in place, then start looking at tweaking and adding more specific controls. The other thing I would say on that in putting your controls and policies in place in stages is be careful, because sometimes what I've seen, and I've done it myself, is we go, oh, something slipped through the cracks here. So we put a process in place to prevent that crack from opening again. But then what we're doing is we're layering controls on top of each other. Instead of saying, why did that happen in the first place? Maybe our original control needs to be replaced, not just add another one. So when you're adding controls in stages, always be prepared to not just add controls, but to revisit the originals. Okay, now I've talked for an hour straight. Sandeep, are there questions in the chat? I think there was one or two in the registration that we were going to look at. If you can read them out to me.
Sure. I have a question here from registration. Someone is wanting to know the difference between nonprofit and charities in finances and taxes. Can nonprofits earn property income, meaning from a rental?
Okay, so I talked about the difference between the two. The registered charities are those that have that status under tax legislation in Canada, and they are a subset of nonprofits. So when we're talking about nonprofits that are not registered charities, so with registered charity, I'm going to start with registered charities. So registered charities, to keep your registration status, you have to do things that are within your charitable purposes. So for example, if you have a building or a facility and it's not used, and you know, 80% of the time on weekdays it's used for your purposes, but nobody's ever here on Friday and Saturday or Saturday and Sunday or whatever, the charity can definitely rent out their space to, you know, for casual use, or if their parking lot is bigger than necessary. Yes, they can definitely rent out their facilities in that situation. Because as long as the charity is fulfilling its charitable purposes, not doing things that are outside of its purposes, and as long as it's, you know, using its resources for its charitable purposes, they have pretty wide latitude on what kind of revenue they can get. Now, nonprofits are a slightly different situation, in that if you look at the section of the Act, that Income Tax Act, that defines nonprofits, it says a nonprofit is, well, there's a number of defined nonprofits. So one of the defined nonprofits, and they're not called nonprofits, they're called tax-exempt organizations. And so one of the tax-exempt organizations is registered charities. Another tax-exempt organization, by definition in the legislation, is, I don't know what the name is, but a union, collective bargaining agreement or organization. Another kind of organization, this is the one that I have trouble figuring out. An agricultural organization is by definition tax exempt. I don't know what that means. Diplomats are tax exempt. So there's a lot. And then there's one that probably 90% of the nonprofits or more that you know of fall into, in that section 149(1)(L), where it says other clubs, associations, organizations, you know, lists all different types of structures you might have, that is organized and operated for purposes other than profit. And then it lists, like, for, you know, for the benefit of the public in some way. I forget what all the terms are, but it's you're doing good for purposes other than profit, and where none of the benefits accrue back to the members. Like, nobody can get a financial benefit from being, you know, on the board or a member of a nonprofit organization. So the key words in that are organized and operated for purposes other than profit. So that means that in your articles of incorporation, where it lists your purposes, it must be very clear that all those purposes do not involve, making money, like bringing in more money than you're paying out. Your purposes must be for some sort of public benefit. And then, so that's organized. It says organized and operated. So that means on a day-to-day, year-to-year basis, the way you behave must demonstrate that you're not trying to earn a profit. And so this what has been from time to time, CRA will go, oh, we need to look at those nonprofits. And so they will start looking at things and they will say, hey, you said you were a nonprofit and you got like $1 gazillion in the bank. How did that happen? Like, that can't have been accidental. Why are you budgeting every year for more revenue than your expenses? If you're budgeting for more revenue than your expenses, then you're operating for profit, is how CRA has often interpreted that. Now, there are some exceptions when you are, for example, condos. They will usually have more fees than their expenditures because they have to build up money for those reserves, or those capital reserves. So there may be situations where you're planning an annual profit, but over the life of the organization, you're not planning a profit. So you have a specific purpose that you're accruing this money. But CRA gets really looks sideways at you if you're a nonprofit, you have no capital assets, and you've got a lot of money in the bank. Like, they're going to question, why are you building up all this money? And so that's background information. Now, you have the question, can a nonprofit rent out money or rent out property? You hate these answers, I know. It depends. So in the situation I was talking about with a charity that has a building and they have some excess capacity, and they rent it out, a venue for, weddings or whatever, because it's free a day a week, we might as well, put it to use. If that income is going directly to cost recoveries, then I think probably there would be no problem. Now, I'm not a tax lawyer, but I think in that situation, there would be no problem. The most common example where it has been a problem is where by renting out part of your property, you end up reducing the costs of the members. And you end up converting what would otherwise be taxable income into non-taxable. So the law case that much of this discussion is built around is a condominium or homeowners association that had some bare land, so they rented it out for a cell tower. And so they had this excess space that they were making money from. And as a result, they reduced the members' homeowner dues. Now, if you have a single family home and you have a great big backyard and you rent out space in your backyard to Rogers or Bell, and they give you money to rent your backyard for a cell tower, you will have to pay tax on that income. If you live in a homeowner association and your homeowner dues were $100 a month, and now because you've rented out your excess space, you're only paying $80 a month. If you were a single family homeowner, you would have been paying taxes on that $20, but now you're not. And so that's the problem with renting out property, is where is it just really recovering the costs? Probably okay. Is it actually reducing the member dues or so on and so forth? Probably not. So I'm sorry, that's a long, complicated answer. It's very, very much and it depends rule. And if you are in a situation, whoever asked that question is in a situation where you have sort of a tricky question, you may get in touch with IntegralOrg and book a clinic with a lawyer who works with nonprofits and present your situation you know, in more detail than what is practical today.